Welcome to ALAQA, a podcast about the relationships shaping systems, capital, and the climate transition. This special playlist is developed in partnership with Change Now. It brings together conversations with fund managers who presented on stage during Friends for Change, and with investors, operators, and thinkers navigating the tensions of impact, climate, and finance. Today, I'm joined by Nadia Nikolova, CEO of responsAbility Investments, M&G's emerging market specialists, impact asset manager, mobilizing institutional capital at scale. Nadia is an investment management expert with deep experience in development finance and impact investing, with a strong track record in infrastructure debt and structured finance. As of September 2025, she stepped into the CEO role as responsAbility, a pure-play impact manager focused on deploying capital into sustainable solutions across emerging markets. Prior to this, she led the direct lending business for Allianz Global Investors across Europe and Asia, having built a team investing in impact-focused investment globally, from small-cap European solutions businesses to blended finance at scale in emerging markets. As an early entrant, AllianzGI was a market shaper in this field. This episode was really special for me because Nadia kept on making striking points after striking points, disrupting the consensus, going where perhaps people of her caliber and charisma are not necessarily expected. And I really loved this conversation, which was a very nice follow-up from the discussion we had at Change Now. 2 points are still with me. One is that she advises the impact players of this world to meet investors where they are, to meet asset owners where they are. Institutional LPs don't buy impact first. They buy solutions to portfolio needs. And as obvious as it may sound, in fact, it's not. And the second, the future of impact is becoming mainstream investing. That's a bit of a hot take for some people. And Nadia believes that this distinction between impact investing and investing should eventually disappear because creating positive impact will simply be part of good investing. Hello, Nadia.
Hi, Ben.
I'm really excited to have you again with me, not on stage, but on the podcast, on the show. I talked about it 2 months ago already when we spoke at Change Now, and I said it online. You know, you have those encounters sometimes that spark something, light something. And I felt so strongly the spark after having the conversation on stage with you at Change Now with Angela from Impact Europe. So thank you for what you said then. But that's why I'm even more excited to have you today. Because we have even more time. And I'm more than happy to have more people listen to the beautiful work and also to the commitment that you're giving to your work and to your endeavors as a team at responsAbility. So thank you so much for accepting and making the time.
Well, very much thank you for having me. It's such a pleasure. And you say likewise. The spark kept me quite excited for the rest of the day. And I'm really happy to be here with you on the podcast.
Thank you. So Nadia, ALAQA, it's a podcast that I started because relationships are at the core of many things in life. So ALAQA in Arabic, it means a relationship. And I see them as infrastructure for change. So one of the first things that we usually do with our guests is to have them talk a bit about their story, their origin story, not so much as a hero story, you know, not so much to emphasize that one day you saw the light and everything was beautiful, etc., but more about what drives you or what drew you to where you are today, but also to tell us about how you see what's next for you professionally in the space of, I don't know, I don't even know how you want to qualify it. Is impact? Is it societal change? Is it change in finance? I don't know how you would call it.
Well, I'm originally Bulgarian, and I grew up at a time of significant transformation, big change, late 80s, beginning of 90s, and then the Russian crisis or the Asian crisis in 97, which really saw people going into poverty. Long lines queuing for bread. If you were lucky enough to have family in the countryside, you may get some provisions. But otherwise, the black market for currencies, hyperinflation was really taking a toll on society. And I lived with my mom at the time. And then 2007, entering the European Union, you see capital changing nations. And now you walk on the streets of Sofia, you hear multiple languages, you see people having an iPhone, you see capital changes nations. And that really shaped me in my thinking of what I wanted to do. And then I told my dad, I'm going to study international relations. I'm going to work for the UN. I'm so excited about all of this. And he said, absolutely no way. And nowadays it would be horrible to hear somebody say, no, back in the day. And he was right. He said, it's really difficult. You're female. And you can, little did you know that the IMF head will be Bulgarian, let's leave that aside. It will be really difficult. One way in which you can really create changes by being successful in business. So there you go. I went and studied more business-related sciences and so on and so forth. That ended up being in finance, where over time I built the development finance practices at Allianz, and now I am on responsAbility.
So it's a story of ideals and realism turned into a bit of idealism as well, and a lot of vision from the get-go of what's useful for society. Very interesting. Thank you. Thank you, Nadia. It's interesting when you said at the time it was okay, but today it would be shocking to hear the notion of women in international relations. How do you see the role and the evolution of the role of women in the workspace and the workplace of finance, and more specifically impact? Do you see an evolution since it started? And I'm happy to share my perspective as well, but I'm happy to hear yours because of the need for more diversity, more lived experiences. So do you see an evolution since you started?
I see a difference between traditional financing and impact investing.
Okay.
So within the impact community, I think historically there have been more women, and therefore you see more senior women. My executive committee is 3 out of 4 women. In my prior job at Allianz, the majority of my direct reports were women. The majority of the teams were women. So I think there is something about there being a wider pool, perhaps, a wider interest. I think the supply is different. I think that's different in traditional finance. I also think once you have a woman in a senior position, we tend to fish in different ponds. I've been incredibly creative about my recruitment practices over the years, whether that's to using associations. I always mentor a number of women throughout their careers. So I always have a roster, if you want to think about it. And not for having a roster. It is really for, I have a passion for mentoring and helping the next generation of women build their careers. So there has been a change. And I think impact community is slightly different than traditional finance.
Coming back to relationships, what relationships really shaped how you think about capital and systems today?
I started my career in credit risk. I did quite a few restructurings over time, and spent quite a long time in infrastructure debt. So invest in infrastructure projects. And you realize you can create impact through your engagement with companies over time. So what I noticed is in 2012, when I was at Allianz, we were building the infrastructure debt platform. It didn't exist as an asset class. And what really helped was there was a Moody's study out there that showed default rates, recovery rates. It really showed infrastructure's really resilient asset class. And that allowed both allocators, asset managers, the regulators think about infrastructure as an asset class and really build that. So the power of data, it's not necessarily a relationship, but the existence of data and how the different players in the market created that. Now infrastructure is an established asset class, and we're talking slightly more than a decade. The moment we started talking about impact, however, investors didn't know what to do with it. And why would I do it? And does it conflict with my fiduciary duty? Even in talking to them about a product that meets their risk return profile and has impact, there's a moment of doubt, there's a moment of skepticism. So this has been really interesting for me to learn over time. Where does that skepticism come from? What does it mean to be investing in a new product? What does it mean to be a first mover in the market? And I think the fundamental part of this is trust. Relationships are based on trust.
For sure.
Sitting down with that allocator, understanding where their reservations are, showing them track record, showing them the numbers, building the trust through that has been incredibly important.
It's interesting because you were saying that you've been incredibly innovative with how you perform your recruitments. Then you just said that you've been incredibly innovative when it comes to opening new horizons for making impact through a rather relatively established and well understood financial product. However, and you see where I'm going right now, it's not a trap, but it's still, there has been a significant stream of people who are excited about innovation in finance on the ground in the space that is called impact. Okay. Because a lot of people knew and saw that things needed to be done differently. And it's been the case for what, 10, 15, perhaps 20 years if you think about development finance, even more so. And on stage at Change Now, one of the topics that we discussed was blended finance is a way for finance to get closer to what needs to be financed in the real economies and to deploy actual impact on the ground. And your hot take was that, yes, there has been a way of important and flourishing and mushrooming innovation, but now we need scale. What can you tell us about this, dear Nadia?
You were very kind to not call it out, but Nadia on stage, you said stop innovating. So why? When your entire career?
I'm not going to call you out because I think there's a lot, and I will call out our community. There's a lot of conformism in thinking that innovation is good, or scaling is good, or data is good. So having one uniform way of thinking through this incredibly complex situation of ours as humanity. And so I like the fact that you challenge what seems to be common sense. Yes, innovation is good in blended finance. So no, I applaud you for that. And I would like you to take as much time as you need to explain why you believe that, yes, we need to do something differently and something at a larger scale now.
I think the scale component is quite clear. There's urgency, and we're doing something, but it's not moving the needle. So what do we need to stop doing so that we can start moving the needle? And this is where blended finance is one of the techniques that they are, but we also live in that capital constraint from the DFIs. My community is getting more and more capital constraint. It has, or it will reach its cap in terms of how much it can scale. And therefore we need alternatives to that. The challenge is every blended finance vehicle is completely different from the previous one. And when you talk to institutional investors that want to invest at scale, they tell you, I need track record, I need prior vintages, I need to be able to invest at least 100 million ticket, and I cannot be more than 20% size. So they need scale, replicability. They need things delivered into a standard form that complies with their regulations and their own requirements. And they want structure that, yes, they will deploy the time today to understand it and to underwrite it, but then it has to look the same in vintage 2, 3, 4, 7, 12. And that is not necessarily what attracts the donor capital or the junior capital into those structures, because they want the innovation, they want the next thing, they want to feel that they're shifting forward, while sometimes the institutional space wants replicability and stability. They want boredom. They want to have done the work and to be able to continue deploying. The consistency with resiliency and with performance. So that is the aspect when I was saying we need to stop innovating, we need to stop creating new structures and new structures. The question is, us as impact investors that have built these amazing capabilities, often on the ground, including ourselves, how do we fit into the institutional allocation without making it complex for them?
Make it an easier yes.
But I think as a community, we often do is we are very focused on the investee companies, into portfolio companies where the impact is, and often forget that the investor focus is really important. How do they need it packaged? What are their regulatory requirements? What are their capital requirements? What are their operating requirements? And they don't want innovation. They want something that fits. So often I find we go to an investor with a square peg to their round hole and say, but we have this great square peg. Well, they have a round hole. So, and I can tell you it's not them that are ready to change. So I think it's about finding out how we continue doing the amazing work we do, but position it in a way that work for institutional capital, in funds, in products that works for them. And I think we're getting better at it as a community. I think we are professionalizing from that perspective. And I also think investors have become more open and curious and more vocal about their needs.
So the pushback and gentle pushback from some GPs, some from impact investors would be, oh, LPs need to be educated on the kind of capital that is needed on the ground. And our structures are designed to cater the actual needs on the ground. And therefore, it's the LPs who should move. It's not us. So what's the answer when one could understand, for instance, for the questions of duration of the vehicles or for the calculation of the returns. Do you take into account, for instance, you put on the side technical assistance buckets because yes, it's more costly to provide technical assistance in some areas or in some topics. So many ways and forms to make it more complex or more complicated, let's say. But the main argument is it's for the LPs to understand that something needs to change on their part. So that's the usual pushback. And we need to educate them more. We need to inform more. We need to explain more. What do you say to that?
I think this is where scale is likely going to lack. I think there will be LPs that are willing to take that effort. And often it's the DFI community that are willing to take the time and the effort to listen and perhaps somewhat adapt or maybe even put their own requirements on it. And there are LPs out there that would also do that for a specific, maybe thematic or specific product. However, they would want the exact same product the next vintage and the next vintage and the next vintage and the next vintage. So if you have gone through the hurdle of educating an LP and they have accepted all of the requirements, don't create a completely different fund after. Does that make sense?
It does. I understand your train of thought. Other question for you, still on that topic, and because I think it's important for us to understand. Do you have an example that you could share with us of a situation where you managed to find ways to be allocated from an investor, like an institutional investor, which is not usually into impact? How did you manage to get to convince them to either entertain the conversation first and then to actually deploy in a way that I'm sure was innovative, dear Nadia? But can you tell us what are two ways that you got to increase the market share, if you will, of impact on the allocation side? Because that's ultimately what is needed at large. So
it's an interesting one. I have had the privilege of working with impact products that are commercially viable. And I think that's the big difference in my career, that whether that was when we build the vehicles at Allianz with the billions behind the development banks in a blended format, or what we do here at responsAbility from microfinance to direct lending through to fund investments, everything I have ever done has been commercially viable. And the right capital has been allocated to the right risk. So you have a conversation, but a lot of the conversation I tend to have with investors is, how does this fit in your portfolio? Let's take microfinance. It's existed for over 20 years. Originally, some of it was within the retail community. The institutional capital came into it. The way you have that conversation is one of, this is a really boring asset class. It looks like fixed income. It's very high diversification, extremely low correlation to anything that's in one's book. So when you position that as part of an insurance or pension fund portfolio, you usually see a really high increase in Sharpe ratios and so on. You talk to the investors for the things that you hear about. What's my risk? What's my return? What is the closest asset class to it? What does it do to my portfolio fit? You have that conversation, and then you talk what you do on the impact side. With investors that are not interested in impact, that have never invested in impact, they wouldn't come for the impact. They all come because this particular product provides a diversification or provides something else, or even you as a manager is a diversification from the traditional managers they allocate into versus what they already have in the portfolio. So it takes a bit of work to figure out exactly what your investor needs so that you don't go with a pitch book that has 20 products in front of them, but you go with, I think I understand you may have a problem. And this, I think, is a product that may address that. It might be duration in the portfolio. It might be currency. For instance, again, in the microfinance space, we invest across 32 currencies. Only 10 of those overlap with public capital markets. That is a phenomenal diversification for many investors. So again, it depends on the product, and you need to understand your client too, to listen, and you need to address a need. It's the same with impact investing, right? For an investment to make sense, it has to address a gap. And of course, you have to have tail needs. That's the primary two components. But you have to be addressing a real issue, a real need in the market.
So on stage, you said something very interesting is about the barriers that prevented some large institutional investors to deploy money into commercially viable impact products. And the notion of incentives came along. What can you tell us here at ALAQA, we talk a lot and we think a lot and we discuss a lot with people who are interested into contributing to systems change. Okay. And so every single one of them has a particular vantage point and has a number of contributions on some leverage points, not all of them, very specific ones. On your vantage point, you, Nadia, what do you see as the best way to engage when it comes to incentives with LPs in a way that would be more productive, beneficial, mutually beneficial, and not too confrontational or provocative to the point where a lot of people, unfortunately, in traditional finance consider that impact investing lectures them and it's very morally pointing fingers and so on. So I'm sure you have given a lot of thoughts to this question of incentives. What can you tell us about the design of incentives in institutional finance or financial institutions that would make sense for more money to be deployed into impact?
It's a difficult question.
I need you to tell us what you think. And you can think with questions, okay? An answer can be a question. It doesn't have to be an answer.
I think as a manager, it's very difficult to control. You have no leverage at all over incentives. But as an individual, you do. Most of us in the West have the privilege of having a pension plan. Some of that is corporate, some of that is personal. But you can ask what your pension plan is doing on impact. You can engage with your corporation of how you've decided who our pension fund provider is and what are they doing on impact. We as individuals choose our insurance policies. And we can ask the question, what is that insurance company doing on climate? We have power as individuals and we have power as a collective. We have power and often we don't think about our financial power. The younger generation has started thinking about how they control, for instance, fashion brands. So that has become more prominent. But I think we also have quite a lot of leverage, our pensions, through our insurance choices, through how we choose what bank to open an account with, and so on and so forth. Who walks the talk? And nowadays, you don't even have to spend much time researching it. You just ask Copilot chats, some of those friends of yours that exist in the alternative reality, and they tell you. It's not even a big time commitment. It is an intention. And this is where impact investing starts, with an intention. So then moving into the GPLP relationship, there's great examples out there with the Dutch NAV or National Finance Report, what they have done with the allocation, the 10% allocation, and the outcomes that have come out of it. I think there's also a little bit of a narrative that we have built over time that all impact investing is either concessionary or submarket returns and so on.
Or illiquid.
With the needs of the new economy, a lot of the solutions that are being built today address societal or planetary issues, and by definition are impact investing. And those need to be commercially viable for us as a society, as a planet, to continue existing. I think the way we did impact investing 10, 15, and 5 years ago, probably, is a very different inflection point versus where we are today. And I question in 10, 15 years, a lot of what we do is going to be impact investing or investing. Because the underwriting thesis is something that we're investing in, something that has an impact on that. Could be a solution, could be something else. But on the solution side, a lot of what the current VC and even before that research is coming out is actually purposeful.
The obvious observation on what you're saying is that very notion of commercially viable a fact, a given fact, or should it be questioned? Because commercially viable in an area or geography where you have droughts, you have physical risks that keep on piling up, should we expect as an LP, should you expect the same level of commercial returns than in another geography where just on the climate and physical risks, there's more stability? That's one thing. And the second thing, obviously, as well, is it reasonable to expect citizens and consumers to do the work of the institutions, civil societies, but organized groups? You mentioned the Dutch NAB, which does a lot of very interesting things. But is it reasonable? Is it even fair for citizens to wait for them to mobilize when, again, it's a question of time and emergency and mobilization? So We had a conversation with Marcel Zudam from Triodos, and his point was that there needs to be some sort of a clear regulation and incentives from a structural perspective, a regulatory perspective, to level out the playing field, because otherwise we'll never be fast enough.
I think sometimes an indication. I'm of the view that over-regulating may have consequences that we are not aware of, because systems are complex.
Oh yeah, by design.
Let me pose an alternative.
Yeah.
What if institutional allocators suggested they will be interested to allocate 10% of their capital to impact investing? But it has to come with the following conditions: risk, return, liquidity profile, and so on.
Mm.
Just by indicating their desire to do so, asset managers will start creating the products.
Oh yeah, with the line, of course.
You don't need to regulate it. There's no commitment from the investors to actually deploy that, but it indicates an openness to consider.
My last question for this section of the podcast is around the notion of inspiration. We can't win by ourselves in a system, in a polycrisis, for sure. So a lot of people are looking up at models, thinking about who should we look up to. Your model as responsAbility and the work that you've been doing for many years, even before you joined the company, is remarkable. What could you share in terms of inspiration or advice, either for fellow asset managers or for LPs, to consider to take that journey of more perennity, more durability, time-wise, more expansion, scale-wise, but also more impact?
I think I will stick with what I just mentioned, with create an openness to potentially allocate and see what comes out of it. Because I think what you will see is diversification to your portfolio, because the origination for impact assets is different and may provide more robustness into your portfolios and so on and so forth. And openness is what I would ask for. Not an allocation. Then the supply has to be right for the demand, but an openness for creating demand.
A call for curiosity also.
Curiosity,
Explore.
openness, and honestly, courage. I think we all need a bit of that.
Oh yeah, a big amount of courage. Nadia, on this podcast, we like to address the notion of tensions, because obviously every relationship comes with tension as in just a mechanical perspective. So what's one challenge you faced navigating complexity, and how did you work through it?
Where do I start? Look, we live in a world where donor, DFI, capital, all the quadrants are getting increasingly reduced. We live in a world in which development finance institutions are increasingly pushed for prioritizing national interests. Those two don't go hand in hand with scam, which is what I came to build here at responsAbility. So the challenge I have is, how do I reconcile great investment opportunity in many of our markets, investors who may not have experience or desire to look at these markets because they can get good returns into their existing or home markets? How do I reconcile that with a decreasing and more fragmented DFI capital? It really feels like a Jenga, and everyone takes a piece. And another in your bed with the bare bones as an asset manager, you're sitting there trying to keep that Jenga still standing. It requires collaboration, trust, and creativity. But I think we have to rethink the model going forward, because unless we standardize it and more, it doesn't scale. So I spend a lot of deep thinking, often late at night, of what can I do? What do I need to do? What do we as responsAbility need to do? What do we as M&G Group, our parent, can and want to do? I don't have yet an answer for you, but it's something that I try to spend some of my deep thinking doing.
Now to the contrarian thought. So would you like to leave a statement that our next guest will be able to comment on? So something that people should do less, or something that people, in your opinion, should do more? A hot take.
Where do you innovate where you don't need to be for the sake of innovation?
And now for the flash round. So this section is big questions, short answers.
All right.
Ready?
I try. Yes.
First, a question you wish more investors would ask.
What do I need to do today that will create a better future for my kids tomorrow that I control within my work?
It's interesting because you see the notion of what can I do for my kids versus what can I do for all the life that will accommodate for my kids and the kids of other people to be able to live a life, a full life with dignity, with joy, with freedom. It's another one of those tensions, invisible tensions that we never take the time to question. But it's always fascinated me when people tell me, oh, I think of my kids. Yes, but your kids don't live in isolation.
I do think that is correct. And I do think that if you want to get a commitment from somebody to change, the best way is to think about their kids.
I understand. That's perspective. Absolutely. Second question. What did you take away from Change Now? So it can be an impression, it can be an anecdote, it can be an idea, anything.
I had the privilege of being in the Pioneers dinner that night, and I was impressed by the number of people that had phenomenal commercial careers for decades and now were pivoting because they saw the urgency and they were asking the question, what can I do to live in a better world? And that I found incredibly inspiring. All paths of life.
What do you hope to see next year in Change Now?
More institutional investors, more investors.
Okay, what should we do to bring them along?
Be curious about their needs, openness.
And finally, what gives you hope in the climate impact space right now?
The economics work. So when you look at renewables, when you look at new technologies, they're fulfilling a real economic gap. That's what I meant, economically, financially viable. This is not a subsidy. We are funding the real economy. And that's what gives me hope, because that has been a significant change. That shift from the old economy into the new economy is creating a massive opportunity. And of course, headwinds. But for impact investing, that's why I was saying, I don't know in 10 years, some of the stuff we invest today are not going to be called investing. And if it is the case, we have won.
Yeah. This notion of renewable investments, technology-driven investments is a fascinating subsegment of the whole impact space. So let me rephrase my question. On the other side of the spectrum, what gives you hope in the capital/social impact space right now?
I think we're getting better at understanding how to underwrite for impact in that space. What do I mean by that? A lot of the social impact space has been constrained because we couldn't attach a KPI to it. One of the reasons climate has been so successful is because we had a metric. We could quantify, we could link performance fees to it. We could make it feel tangible. Social has been difficult. Am I looking only at jobs? Am I looking at beds in a hospital? I don't have a one metric. But the increased sophistication of being able to assess impact in many institutional investors and families means that we talk less about KPIs and more about the how. How are you originating? How are you underwriting for impact? How do you create a baseline? How do you create sensitivities to that baseline? How do you engage? And less about what is that one KPI? What is that portfolio KPI? So with sophistication comes a different dialogue. Jamaica put so many different climate resiliency, and not just climate resiliency, but hurricane, natural disaster resilience, protection into their bonds, into their guarantees, into various of their infrastructure. That when one of the large hurricanes came after, they got upgraded by a rating agency because it worked.
So it's a stress test in real life, in fact, when you think about it. It's interesting.
So what I meant by economic value of what we do, this is the economic value of what we do. Once you're upgraded, that means your cost of capital then is cheaper, and it creates an economic argument for preparing today. And I find this incredibly powerful. So there's some positivity.
Thank you, Nadia. Thank you for listening to ALAQA. If this conversation sparked something for you, share it, leave a review, and subscribe for more dialogues at the intersection of capital, systems, and transformation.